Next topic. The markets have been spooked recently. Some thought is that it's part of the yen carry trade unwinding. Austin, I want to start with you. And can you explain at a basic level to investors what that means?
Yeah, I wish it was really simple, but basically what it comes down to, and trying to simplify it, is that interest rates are really low in Japan. So people are borrowing in the yen at very low rates and reinvesting in areas that they can achieve higher returns. And one of the areas that many people have achieved higher returns in the last few years has been in big cap US tech. And so what you saw as interest rates went up, or as the Bank of Japan increased interest rates in Japan, it all of a sudden caused a bunch of these people that had borrowed yen and bought big tech. It forced them to sell their big tech to pay back the yen, which created a pretty dramatic sell off in the markets. It's been compared to some of the long term capital management currency fluctuations back in the late 90s. I don't think it's clear at this time what actually happened or what the ultimate shakeout is going to be, but there's no shortage of people speculating on what's going on right now, which makes for an interesting news cycle.
Adam, what are your thoughts?
Look, it's interesting because if someone says, "Hey, I'm going to give you $100 and you don't just pay me the $100 back in the future, zero interest rate, and I could go buy a U.S. Treasury yielding 5%. I'm just feel like I'm making 5% on my money, with zero risk. Of course, the problem is that assumes that currencies don't change, the interest rates don't change, and a lot of people made a lot of money by using that interest rate arbitrage. But those things always end, and the real question is how levered is it? And what's going to happen and where has that money gone in terms of what gets hit when it ultimately has to unwind? Because people are going to get spooked at some point, and then they're going to look back at how much money they've made over the last few years, and they're going to want to lock in those profits. And typically, it all happens at once, and that's why you get that snowball falling down the hill effect, which we saw earlier this week.
And Adam, there's some thoughts that if the Fed were to step in here in the U.S. due to recent market turmoil and start lowering rates, that could impact the yen carry trade and exacerbate the situation. What do investors need to know about that dynamic?
Well, look, I think about it very simplistically, which is, if U.S. rates go down, all else being equal, investing in the U.S. is less profitable, and that has a currency effect where the U.S. dollar comes down. Which means the U.S. dollar buys less yen, which means it's more expensive to pay back the money that you've borrowed in yen. But I do think this notion, one not great job print led to this sell-off and all these headlines from these talking heads on cable TV talking about, is the Fed going to do an intermeeting rate cut? Of course they're not, you morons. Like, it's a great headline. It's clickbait. It's nothing. It's fake news. It's amazing that people that want to be known as respectable business journalists would suggest that, not even one data point, and the Fed's just going to all of a sudden completely change course and do a sort of, and not an unprecedented, but a emergency move. No, they're on pace to cut in September, and the real question is the cut going to be 25 or 50, or is more data going to come out that will change what that could be? But this idea that Fed's going to panic, have an emergency meeting, and Neil Kashkari is going to say, let's cut rates. It's not going to happen.
Yeah. Listen, if you're managing your portfolio based on speculation of the yen carry trade or what the Fed's going to do next week, you're doing it wrong. Right? Like, if you want to avoid the impact of the yen carry trade on your portfolio, how about you look at fundamentals and buy something that makes sense based on the fundamentals, not based on what the Bank of Japan is going to decide to do with interest rates or what Neil Kashkari is going to influence Jerome Powell to do with interest rates in the US. It's impossible for people to understand what's going on in these people's heads. So a much more simple or a much more straightforward approach would be just to focus on fundamentals. It's not that complicated.
Right, because they talk about like how much aggregate market cap was lost in the sell-off, and it's a huge number, and it's staggering, and you're like, wow. But how many people sold at the bottom because they panicked and missed this 2-day bounce? And what's the amount of money that those people who are probably large, maybe there's some professional investors and also just regular people making day trades in their Schwab accounts that just lost a considerable sum of money because they saw headlines on the news and Buffett's selling Apple, Fed might have an emergency cut. The world's falling apart. The world fell apart for it was 3 days. The S&P was down less than 10%, which, by the way, a 10% drawdown over the course of time happens almost every year, and yet the sports center of the stock market, CNBC, fuels the panic.
Schwab, Fidelity, and Vanguard all were down on Monday morning, and you just wonder how much money that saved people because they couldn't do what they wanted to do, which is most likely sell in the down market.
It's like missing your flight to Vegas. It saves you money in the long run.